Hello and welcome to another Wade Gordon Signals tutorial. In the last lesson we covered the concepts of risk-on and risk-off sentiment. In this tutorial we will cover how to understand the economic calendar, a tool which gives us an idea of which direction specific assets are more likely to move based on released economic data. Understanding an economic calendar is, in our opinion, one of the key attributes to becoming a successful binary options trader. Economic calendars are a free resource widely available online. Our personal favorite economic calendar to use is Forex Factory, which is available by going to www.forexfactory.com. Here's an example of what the economic calendar looks like. Reading from left to right on the calendar, the typical headings include time of date of the release, economy or currency that will be affected, description of the economic data release, volatility rating, low, medium or high, sometimes color-coded as yellow, orange or red respectively, the actual figure, the consensus or forecast figure, and the previous released figure. Just a point to note, always check the time on the economic calendar each time you visit and make sure it matches the time on your computer and your time zone. Otherwise, you'll be waiting for information to be released which may have already passed or is not going to be released for a few hours. You'll end up getting yourself confused, so please make sure your times are synced correctly. As binary options traders, we focus on the high-impact red events more so, as these present the highest volatility, the most movement, and thus the greatest opportunity for us to profit. These high-volatility red events tend to be data releases such as GDP, gross domestic product figures, employment data, retail sales figures, CPI, consumer price index figures, manufacturing, construction and services PMI, purchasing managers index figures, central bank interest rate decisions, and speeches by central bank governors. This data is released for each of the major economies throughout the month. The major economies being the Eurozone, the UK, the US, Switzerland, Japan, Australia, New Zealand, Canada and China. With released economic data, generally if the actual figure for the data comes out higher than the forecast figure, it is seen as positive for the relevant economy as it shows growth. What we tend to see this situation is a strengthening of the domestic currency and a strengthening of the domestic index or indices. If the actual figure for the released economic data comes out lower than the consensus or forecast figure, it is seen as negative for the relevant economy as it shows a contraction or worse performance. What we tend to see in this situation is a weakening of the domestic currency and a fall in the domestic index or indices. These are the rules of thumb to follow. Let's make this easier for you to understand by covering a few examples. Say US employment change figures have come out better than expected, showing more jobs created in the previous month. Higher job creation is generally seen as good news for the economy, in this case the US. Good news for US economy, so typically traders would flock to the US dollar and it would strengthen. We could therefore trade currency pairs like USD CHF and USD JPY to go up, as the US dollar in these currency pairs is the base currency. And currency pairs like Euro USD and GBP USD we can trade to go down, as the US dollar is the terms currency on the right hand side in these pairs. Let's look at another example. Say UK retail sales data has come out worse than expected, showing a decline from the previous month. A drop in retail sales is generally not seen as being good for the economy, in this case the UK. Bad news for the UK economy, so typically traders would sell the Great British Pound and it would weaken. We can trade currency pairs like GBP USD or GBP JPY to go down, as the Great British Pound is the base currency. And currency pairs like Euro GBP, where the GBP is the terms currency, the one on the right hand side, we can trade to go up. And that's all it is to it. You're probably now wondering, how do I know where to enter my trades and what sort of expiry time should I select? Don't worry, we've got you covered in the next tutorial. Until then.